My name is Jeremy Wiseman. I'm joined with Jerry Correa, both from Guildhall Wealth. The number 18778-SILVER, the website guildhallwealth.com, and welcome to joining us on The Real Money Show today. We are going to be talking about silver's coiled spring. And we're also going to talk about supply demand, what it looks like right now for inventory and supplies in the metals market. We're going to touch on the price suppression of silver, hence the coiled spring. We're also going to talk about using gold and silver as a trading vehicle. Is it something that you should be doing? And most importantly, I think one of the biggest topics we're going to cover today, Jerry, is going to be inflation. I have an article here from the Epoch Times with the title that says, "Inflation overtakes the CCP virus as the biggest risk for investors, according to Bank of America." What do you think about that title out the gate?
Well, it's truth. Inflation does exceed. It should outweigh other headlines, other negative headlines, but we just typically don't understand inflation. Is that right?
Yeah, I mean, look, at the end of the day, we just started to see gas prices take off. Commodity prices are rising. There's supply chain issues everywhere. And so how is that not going to affect the silver market when you need oil to dig for silver? You're going to have with going green, you're going to have environment restrictions with regulations. It's only going to make it harder. And so costs are going up all the way around, right? Transportation costs, things like this. So prices are rising everywhere. We already saw it in food prices.
Yep.
All of the money that's being created, you can't just assume that it's got nowhere to go, that it's being created in a vacuum. Although it feels like that because no one is actually getting direct access to it. Measly $1,500 here or a CERB payment or whatnot, but it's not like helicopter money, right?
No. It's definitely not helicopter money. In the CERB, we just learned that it's taxable income, so it's not really ours to begin with.
Yeah, that's what we're starting to learn. Let's talk a little bit about inventory and supplies. Do you have people asking you how are your inventories, or do you have this, or assuming that you don't?
Yeah, that is a question that is coming up often. We do have that up on the e-store right now, that there could be delays of up to 3 to 4 weeks. That's if you have a high volume of bullion purchasing coming up. So just be aware that there could be a few days delay, but we do have product. Thankfully, we have 100-ounce bars, PAMP RCM, 10-ounce bars, Asahi RCM. Lots of silver maples in stock. Gold maples are coming back. So we do have the inventory. So just to communicate to the listeners, we do have inventory, but it's always prudent to check in with us first. And
as well, what we're moving back to with regard to inventory is what we've seen in the market over the last few years, which is, yes, there's inventory out there and small orders are quite easy to fill. But if a large order comes around, if a lot of people all decide to buy at once, it can zap the market really quick. Just like in February, it zapped the market all the way back to the refiner, right? So it cleared out the retailers, cleared out the wholesalers, and then it takes you back to the refiner. And I think that also leads to the idea of why we're seeing premiums still quite high in the market, because as you've probably noticed, silver is still trading $4 or $5 over spot. We've seen the premium come down a little bit on gold across the retail sector, but it's not falling from the wholesaler side, right?
Not at all. This is just, especially on the silver side, as you mentioned, this is just indicative of very little silver coming out of the ground, going to wholesale, and coming to us. The costs are moving up, and the premiums, I do believe, can tighten a bit on silver, but I think high premiums, I think with the spot price and the future prices, will have to correct.
I think what we're looking at for premiums right now is if you have someone, let's say you're thinking about buying metal for the first time, and you're wondering if you should wait for the premiums to come down, right? Like maybe a $5 spread is just too much to bear to acquire some silver right now. So maybe you should wait until that premium comes down a little bit. And I think that's something that's on a lot of people's minds. The question becomes, okay, so what is it going to take in our market for those premiums to come down?
Supply yields. The silver production yields have to start miraculously rising. And we're going to be touching upon that a little later about the news that is coming out regarding the world's top 7 primary silver producers. Year over year, silver is just tumbling. The yields are going down. How are we going to crank that up especially if we have the new Green Deal telling us we can't, use these trucks, these massive trucks to haul millions of tons of ounces of ore? It's not going to happen.
So on the one hand, you've got a fixed amount of mine supply. That's actually, we're going to be talking about the fact that it's been dwindling. We're losing mine supply. So it's not like we're snapping our fingers and mine supply is going to double overnight. So, okay, that's fixed. And then you have the fact that most wholesalers are buying from the mints and refiners many months into the future, right? So those orders have already been purchased.
Yep.
So you're going to have to see sustained lower prices for a very long time before the wholesaler is acquiring that product finally at a lower price potentially. And I feel that that's a game of chicken, personally.
Sure, yeah.
Because I think that if you look at, okay, we had the pandemic scare last March, and silver did a moonshoot between March and August. And then you saw what happened in February. So you had it happen twice within 1 year. Massive gains in the market, massive premiums. And we've been sitting with these premiums all year. So you could even look at it in that sense and just say, okay, well, wait a minute. We had a high premium starting in March of last year. Well, now it's March a year later, and those premiums are still with us. And the price of silver has moved up from $18 to essentially $26 an ounce,
yeah.
$27, and that premium is still there. So are you going to wait another year? Should we be waiting another year before we acquire? And what could possibly happen within the next 3 quarters? I always like to remind people that I'm speaking to that we're still very early in this market in terms of the year. It's only the end of middle March.
That's right, and a lot has happened since the beginning of the year so far. We have seen a new administration come into the U.S. Fiscal policy, monetary policy, just running away. We had 1.9 trillion of a COVID relief, and another 4 trillion perhaps coming down the pipe for infrastructure out of thin air. Of something that is not intrinsic. So, we're not seeing the traditional inflation hedges of our gold and silver generating much attention right now, so far in 2021, at least not in the futures markets and the spot prices, but bullion demand from our investors, our listeners who are concerned about inflation risk has been quite robust, to say the least. The demand for physical has been in an extreme because inflation is that thing you're playing chicken with. Should you be waiting for premiums to start falling? What are you going to be waiting for? You're going to be waiting for inflation, which is coming down the pipe. So rather than waiting for premiums to drop maybe by $1 or $2, what happens in inflation? We talked about that on the last show, where inflation went up into the double digits. Stock markets crashed by 50%. Silver and gold took off. And this time around, as opposed to the 80s, can you get your silver? I don't know. So rather than waiting, rather than playing chicken, we're not here to roll the dice, play the roulette wheel. Get your insurance policy now and hang on and wait and ride out this ride.
Well, speaking of insurance policies, first the number 18778-SILVER and the website guildhallwealth.com. Speaking of insurance policies, if you are looking at trying to insure your wealth, you want the actual physical product, right? You don't go to the insurance company and say, I need an insurance policy. They say, great, we've got this one, and this one. You say, no, I'm just going to buy the stock. Huh? No, they say, what are you talking about? Here are our policies. No, I just want to buy stock in your company as an insurance company, and then I've got insurance. It doesn't work that way. You actually have to buy the policy. So those are two different things, the stock and the policy. So there are trading vehicles, and there is actually having the specific insurance. And having insurance in the precious metals market means actually owning physical.
Full coverage.
And avoiding counterparty risk. So this is inflation is something we're going to talk about a little bit more throughout the show, because it's not just what's happening from the Epoch Times and seeing Bank of America seeing it as the biggest risk overtaking the CCP virus. But it's also something that is starting to make headlines in mainstream media like the National Post. I'm going to share an article with you from that Pierre Poilievre has been discussing on his Twitter.
Great.
And then we'll also have coming up talking about the supply more from Steve St. Angelo. Mm-hmm. And you've got something here from the Money Metals Exchange?
Yeah. Just a summary of what was spoken this week from the Federal Reserve. As we know, they spoke, kept things the same, but highlighted a few aspects, including inflation.
Dovish talk and trying to jawbone the markets into your way of thinking. Is it going to work? Does he have the magic wand? We'll find out. This is The Real Money Show, the number 18778-SILVER, the website guildhallwealth.com. We'll be right back. Welcome back to The Real Money Show, the number 18778-SILVER, the website guildhallwealth.com. Let's talk about the Fed, and what we're going to do is change the name of U.S. dollars. Is that right, Jerry?
Yeah.
We're no longer calling it U.S. dollars.
It's not a dollar, no.
No, what are we going to call it?
It's the U.S. Federal Reserve note.
We're going to call it by its real name.
Yep. It's the Real Money Show.
We want to encourage everyone to call U.S. dollars by their real name.
That's right.
U.S. Reserve Note.
Federal Reserve Note.
Federal Reserve Note. It's a mouthful.
And that's what they're getting. That's what the markets are getting.
The U.S. Federal Reserve Note.
Yep.
So the Fed prints their own money. They lend it to the Treasury. The Treasury owes them the money back with interest. This is the money system that everyone is working with. This is reality. And pop quiz, is the Federal Reserve federal?
As federal as Federal Express. No, they're not federal at all.
That's Federal Express. Good answer.
Yeah.
Yeah, they're private.
Mm-hmm.
They're private. And currently their debt, their book, is coming up to $8 trillion. On what they're holding on their books. That's not including the U.S. debt. That's just including their own book, mm-hmm. which they've never paid down. They tried to pay it down a little bit in 2018, and the market freaked on them, right?
And it's their job to say that they're thinking of tightening. It's the prudent thing to talk about. Yeah, I mean, you just can't keep printing without having some sort of a way out. So they're going to mention every now and again, we want to tighten. We may normalize, twist our way out of things, but we know that they never do. They're going to kick the can down the road, which is what they talked about this Wednesday. This Wednesday or Tuesday was Jay Powell Day.
Yeah, which is why we're talking about it. And it's, the way every chairman, chairwoman of the Federal Reserve has ever talked to these Congress people, it's always so condescending in a way, and it makes you wonder, are the congressmen and women dumb or complicit?
Well, they have the power to create the nation's money, so they really don't care who makes the rules, do they?
Right, and they've all been in power for way too long anyway. So
that's right.
They just let it happen. The money's just getting printed everywhere like crazy. I think Canada's done the worst, right? They've been the biggest perpetrator of money printing per capita.
Yep. Right?
It's been absolutely brutal, and people notice that.
Yeah, and it's not like we're an economic powerhouse, but we're a powerhouse in money printing. So it's going to have a really big impact here in Canada.
And when you think about money being created out of thin air, like in the U.S. with the COVID relief, or infrastructure, it's easy to throw out numbers like hundreds of billions and trillions, but no one ever thinks about the waste on all that and where the waste goes and the runoff. We used to, in the restaurant industry, we had a thing called spillage, right? Where what spillage was, I spilt a drink. Mm-hmm. I may have spilt it down my mouth, but that's what it was. It was offtake. Right. Yeah. And how all that money gets wasted. And I think people over the last year in saving money, those who've been, lucky to keep jobs and keep working, they can't go to their favorite restaurant. They can't go to get some favorite retail therapy. They've been saving. And now I think there's they've been able to audit themselves and say, wow, I wasted a lot of money over the years doing this, that, and the other. I've spoken to someone the other day. He said, man, I haven't paid for a coffee in 6 months.
Wow.
Yeah,
that's right.
So I think people are going to be a little more frugal with their money, but there is also a lot of money there to spend.
Yeah. And we're seeing that right now. A lot of investors are, look at the property market. It's definitely a seller's market. A lot of inventory coming, and people are, again, they're not really into parking their wealth back into another property. Some people are, but many are looking towards precious metals.
Well, we talked about that last week, looking at that article from Better Dwelling, how low interest rates is giving the wrong signal to the market, because if there is low risk environment, you would have low interest rates. If you have a high risk environment, you should have high interest rates. But if you're not getting that signal, then people are getting the wrong notice, right? Or the wrong note, the wrong signal to themselves.
Yeah, it's a barometer.
So people just assume, it's not a high risk environment. It's just a FOMO environment, right? And so we have to take advantage of it. And that can be a successful strategy in and of itself, right? But last one in is the first to get hurt.
Yeah,
we're looking for value. And I think when it comes to precious metals, we're looking to see that. Obviously, even gold. Some people think gold is expensive. It's 17 plus an ounce of U.S. Federal Reserve notes. But at the end of the day, it's actually very inexpensive when you compare it to the debts.
Oh, yes.
And silver is crazy
so
undervalued.
That's right.
But the big thing with silver, Jerry, and I'll ask you the question, is, the price suppression. It's the $1 million question. When, how do you get involved in a market where there's suppression of the price?
It takes education, Jeremy, and this is one of the reasons why we have this show. We've been doing this proudly since 2008. It's been an honor to, and really just want to thank all the listeners for continuously tuning in and supporting the show. But one of the fundamental drivers is supply and demand. And you can continue to try to manipulate and keep a price down, but without the physical underlying asset of these futures, these options on futures and ETFs, which say it's physically backed by physical, but where is the physical? And when you have the investor saying, well, I own this, I want to take delivery of my physical now. Well, does the entity have the physical silver to back it up? The house of cards starts to fall. The ripple effect will have an impact on the credit market. Then don't forget, we have quadrillions of toxic derivatives still on the bank's balance sheets. So this is a ripple effect. So as we saw in the 80s with the London gold pool, they tried to do the same thing. Manipulate prices, keep the price down. Don't look over here, as you mentioned, interest rates is a barometer of risk to take or not to take in the market. Similar, gold and silver are the barometer as well. If the gold prices begin to rise, it may signal to the investor, hey, something's going wrong, and they can't have that. They need to kick the can down the road. But our investors see the writing on the wall. They're reading about it now. Epoch Times, Bloomberg, Bank of America. Their common theme now is inflation. You can't print 1.9 trillion. You can't print 4 trillion. So inflation is coming down the road. And then, SRS Rocco reports this week that the 2020 results are in about the top 7 primary silver producers. And he writes, if they look at the first year of 2005, it took 9.4 tons of raw ore to get 123.
How much?
9.4 million tons of raw ore to get 123 million ounces of silver, a yield of 13 ounces per ton. And that and today we're seeing that cut in half. So year over year, we're losing silver. It requires much more work, many more trucks pumping out carbon dioxide, bad for the environment.
Right.
You can't have that. So when the supply dwindles, and now the investors are taking a huge portion of the silver, seeing, okay, this is my opportunity here, I'm going to grab my piece. This price suppression, manipulation will come to a halt.
I'm glad you brought it back. Good job, by the way. You went out and then you pulled it back in. That was really impressive, actually. Well, I have another take on it as well, because, you mentioned the London gold pool, and the whole purpose of having the COMEX and price suppression, as you said, which is a whole other topic on its own about creating mixed signals. Right? If you try to keep a lid on the price and keep it low, then it sends a signal to the market that there's no problem with the U.S. Federal Reserve note. It's a strong, powerful fiat currency. There's no need to get away from it. Equally, all the other fiat currencies around the world.
Right.
And so you send a signal to the market that says, no, you don't want to hoard physical metal. Right? And in some ways, if you take the other side of that trade where you say, no, I don't agree with you, I'm going to buy this, and by the way, you've suppressed the price, so you've given me a cheaper deal.
Right.
It can be demoralizing because the price isn't skyrocketing, and you're playing the wait game on when is this going to skyrocket? I bought it cheap, but I'm waiting for it to rise. I always like to point out that both gold and silver over the last 20 years, with all their ups and downs, have averaged over 11% a year. So at the end of the day, silver has still risen from under $5 an ounce to $26, $27 an ounce. Gold has risen from $250 an ounce to $1,750 an ounce, and we haven't even gotten started yet.
No.
The inflation story, which is the biggest story for the market, is just getting started. And when you look at what's happening in the markets for price suppression, you see, okay, the more they suppress the price, the more they're harming themselves now.
Yep.
Right? If they let go of the price suppression, the market skyrockets, they're going bankrupt. That's a problem. And the more they push the price down, the more the savvy buyers come out and want to buy the lower pricing, which is why the question becomes, are you going to wait for the price of silver to drop to $15? Because when it does, you won't be able to buy it at that price. And if you could, the premiums are going to go sky high. They'll go to $10. Right. Ed Steer, we put out a video last week into our newsletter where he talked about that, and he just said this game is almost up. It's almost up. We've seen it for years. The problem is when you're just looking at the price, you said it out the gate. You said it. It's about education. If you're just looking at the price every day, there's no education in that. There's nothing. Right? You're just scrolling through Instagram, right? It's the same thing. You're just scrolling through tweets, getting some news. It's not giving you anything. You have to actually get educated, and that's why we're looking at, just in this case, one example, which is the SRS ROCO report.
Yeah, and Steve St. Angelo does a great job in summarizing, and he concludes by saying, with more than 250,000 truckloads of ore to produce the same amount of silver, no wonder the cost to produce silver is going up. And by contrast, more fiat is created by the keystroke, by the Federal Reserve. They call it printing. And the catchphrase is, the printers go brr, he says. I mean, while much this year has been written about the real price discovery of silver and gold, amid the futures actions by the bullion banks, at some stage, reality has to hit, and true price discovery driven by supply and demand prevail. So he's concluding by saying supply and demand, the lack of the silver will be that catalyst. And he concludes, the above data, in which we'll share the charts in our next newsletter, hopefully, the above data just winds that silver coiled spring all the tighter. We haven't even started. The inflation narrative is now creeping in. The machines are cranking up. The machines are going burr. The silver and gold haven't done anything yet. Amidst all of the other bubbles, we're going to be the last of the party.
Yeah, and the premiums are high, which tells you everything you need to know in terms of if the premiums are high, that says there's not a lot of product out there. So you want to take advantage of that. You can take advantage of getting into the physical market by contacting guildhallwealth.com or calling us direct at 1-877-8-SILVER, and we'd be happy to assist you to get some physical precious metals in your portfolio today. And you can do that direct. You can store and insure that product with our independent IROC approved vault facility outside the banking system, or even hold it in your RSP, directly own it in your RSP with allocated segregated accounts. Again, the number 1-877-8-SILVER, the website guildhallwealth.com. You're listening to The Real Money Show, and we'll be right back. We've been talking about the Federal Reserve note. We've been talking about inflation. We've been talking about supply demand. One thing we need to discuss, Jerry, before we move into this article that you have, is a question that we get often at Guildhall. Not often, but sometimes. Someone will say, trying to understand the market. If I buy silver today, what will it cost? And let's say it costs $31, just under $31 today in U.S. Federal Reserve notes. Well, what would it cost if I sold it? And there's the rub, because it sells at spot price minus 2%, and that's sort of the industry standard. How do you normally deal with that? Because that's a big swing, right? For someone for the first time understanding that you're buying it and there's all these costs to acquire this fabricated product, but yet if you sell it, I don't get any of that.
Yeah. And it's an important question to ask, and it's one that we have to address and hopefully educate properly. It's about removing the old lens and putting on the new lens, this is physical bullion. It's similar to what you're used to. You go into the bank and you want to buy euros. You're going to Europe, so the European rate is 1.2. The bank will charge you 1.24, but then you say to the banker, hey, I want to sell these euros right back to you for Canadian. The rate's 1.2 right now. What are you going to charge me? Well, 1.16. So you see there is a spread for the ask and the spread on the bid, similar to precious metals, but now we're talking about physical. There is shortages, supply shortages. So therefore, there's going to be a higher premium on the buy, as we always talk about in the last few weeks. So as long as you understand your why, and the reason why you're buying is for wealth protection. This is your insurance policy. This is not sort of your day trade, your tradable asset where you want to do a quick flip. I understand. We want to do the same as well, but not for this. And our hope is to, yes, prepare on the medium and longer term for some great gains. With the day, when that time comes, you're going to look back and you would have, you're going to laugh and about quabbling of where you should be buying. Should I be buying now? No, because the gains to be had are going to trump anything that we're discussing today, these small premiums.
Yeah, I like that idea of one thinking about it as a currency exchange, in that you're converting into hard money. I think the other thing is to keep in mind that it's not a trading vehicle, right? In the last segment, we talked about insurance policies. You're not investing in a stock. You're actually buying a policy. So there's a difference between investing in something, taking on counterparty risk, and there's a low cost to invest in, when it comes to stocks or paper.
Yeah.
But when you're buying a policy, you're actually buying the policy, and so there's a difference, right? If I invest in a car company, it's different than buying the car, right? Any Tesla investor will tell you that. So you definitely have to view it through a different lens. I also think that when it comes to the hard asset, something else to keep in mind is, in a crash, people will ask the question, where did the money go?
Right.
Where did it go? It just disappeared. It just seemed to just disappear. And that's because there is no money there. There's only money there when you sell it to someone who's willing to buy it.
Right.
And that's when the money exists back to you. But when you're holding a stock, you're not holding anything, right? You're holding the promise of being able to sell it.
Yeah.
Whereas with metals, they have an inherent value. So they've never gone to zero.
That's right.
That's the key, right? It's not an investment. It's an asset, and that's what you're doing. You're not buying a trading vehicle. You're buying an asset, and there are costs for that. And the benefit of that is that it doesn't go to zero. That you could bury an ounce of gold for thousands of years, pull it out of the ground, polish it off, and it's as good as it ever was. And if it was a belt buckle, you could still wear the belt buckle. If it was a coin, you can melt it down and turn it into a today's coin.
Yep.
That's an inherent value. That's a very interesting thing to know. And it's also very satisfying to know when you have that in your possession, because there's a comfort there, a security there.
That's right. Even more so, I talk about the value of the precious metal. Yes, you're putting your trust in the metal itself for the long term. Very easy to pass on to your next of kin, your inherit, your dependents. So you have to ensure that that you're dealing with a dealer like Guildhall, a trusted dealer who knows what we're doing, and we're dealing in LBMA product. I think the LBMA is something that they set certain standards that are very important, especially knowing that it's a chain of integrity that is intact, that the gold and silver were ethically mined, And you're not going to be dealing with refiners that are fly by night. These are going to be either backed by the government or well capitalized. So as long as you're getting the proper gold and silver that has been hopefully not going around the block and uncirculated, we're giving you brand new product at Guildhall.
Yeah, and look, at the end of the day, we've said it before, we'll say it again, high premiums in this market tells you the supply is tight. Even if there's some physical product coming back into the retail sphere, it's not a lot.
No.
It can easily be zapped again. There's a lot of excess money out there. People are seeing the inflation story. They might decide, hey, I'm gonna protect my money a little bit more. I've saved it over the last year. I want to protect it now, as opposed to maybe going out and spending like they used to, because I think that's going to be a big story going forward. The economy opened up again. I don't know, unless there's a third wave, but the economy opens again. People want to spend money, but they don't want to just let go of all the money that they have saved, right? And they want to protect it.
That's right.
Now, inflation is going to be a huge story. It came out in the National Post even, where the title of the article was "Inflation is Coming, Signs That Everything is About to Get Much More Expensive." This writer was talking about, one of the things he says is, if you haven't noticed, the price for everything has already virtually skyrocketed. Lumber prices are out of control. Groceries are out of control. Gasoline is on the rise. I remember, Jerry, literally just a few months ago, we were saying, well, the food prices are up, and we were actually kind of stretching to see what else had gone up besides food prices and groceries. But there you have it. Now you've got the price of gas going up, which is going to put even more pressure on supply chains. That's something to watch in general. To now ship something from China is going to be that much more expensive, and they're not shipping a whole lot, so that's even more expensive because it's not a volume-based business anymore. So all of these things are adding up to higher and higher costs. And even if the government says, "Oh, we're trying to get inflation," the everyday person is like, "Are you kidding me? We're already there, buddy." Right? It's just another sort of check mark on why are we listening to the government about these things?
Yeah, their quote-unquote core inflation indicator excludes fuel and food, the two very things that are necessary for life. Again, a lot of smoke and mirrors with regards to inflation readings.
The government has been utterly blowing out their spending, and we're going to tell you how to deal with it in the next segment of The Real Money Show. The number 18778-SILVER, the website guildhallwealth.com. Stick with us. It's The Real Money Show on Global News Radio 640 Toronto. Welcome back to The Real Money Show. We are going to try to do something here that has never been done before. We're going to try to make the subject of inflation exciting. It's not exciting at all. It's brutal. It's terrible. It's like, who cares? At the end of the day, who cares?
If you own gold or silver, who cares?
But you have to understand the game.
Right.
If you don't understand that inflation is robbing you of your money every day, and if you don't understand what real world inflation actually is, whether it's 5% or 6%, you have to understand that it is robbing you of your wealth, and that you have a threshold of what you have to do to keep up. Now, if you're in sales, you can say, okay, if I'm selling cars, it's like, okay, I just need to sell an extra car, right? If you earned $100,000 10 years ago, if you haven't received a massive pay raise, that you probably need, when you look at it in reality, you say, I probably need $150,000 or more just to keep up with what I was making when I was $100,000. I don't know. Maybe your family's grown. Okay. Maybe there's new expenses. Maybe there's some new gadgets, right? But at the end of the day, it's lifestyle. Am I keeping up with my lifestyle? Am I having to convert to all of a sudden, having Campbell's soup? Or do I get to still go out for dinner, right? And that's real world inflation. And you can't kid yourself about that.
Not at all. Especially you have to keep up not only with inflation, but taxes. We heard new tax hikes are coming, the biggest since 2013 in the U.S. So tax is another thing that we have to beat.
So I want to get back to this article from the National Post because I think it's a good jump-off point, diving board for this. One of the things he talks about is that as the value of the dollar goes down, you need more money to buy the same amount of goods. And he gives the example of a Big Mac. In 1978, it cost 88 cents. And in 2021, it cost $5.69.
Gee.
That tells you, right? Same thing with shrinkflation, which we've covered ad nauseum on the show. There's less chips, and I like also. You know what I'll also like? I like the move towards, making things gourmet. That's a way to spend more money, right?
That's right.
If we just make it, let's add sea salt.
Yes.
Well,
Himalayan.
If it's Himalayan, I got to spend more money for
that. Yes, justified.
Of course, it's a luxury item.
I was actually looking at the Big Mac the other day. It doesn't look that big anymore.
Well, you're bigger.
Higher.
You're bigger. Your appetite is bigger. Is something we've just kind of been touching on a little bit throughout the show, this idea that people have been saving some money during the lockdowns and whatnot. And part of the article, he goes over this idea that with a widespread of business closures, that a lot of money is going to have to go somewhere. Right? He says Canada is essentially poised to undergo a macro version of what happens in remote boom towns. In Dawson City during the Klondike gold rush, which, by the way, is about as close as this writer gets to talking about gold, doesn't mention that you should own gold as a way to hedge against inflation, which I think is absolutely nuts. Getting back to the Klondike gold rush, you had a disproportionate number of new millionaires stuck in the middle of nowhere with limited means to spend their new fortunes. The result is an utterly ridiculous bidding up of relatively pedestrian commodities such as fresh eggs selling for the modern equivalent of $100 apiece. That's very interesting, this idea that as the economy opens, there's a whole bunch of stores and businesses that are no longer there. And so now the money has to go somewhere else if it is going to be spent.
Right.
And as a result, that's going to drive up whatever prices are being offered at those places. And that's what's going to drive the economy for the next little while, which could tell you why the Fed, for all of their charts and graphs and, graduating from Yale or whatever, can somehow predict that, there'll probably be a spike in economic activity. Duh. But how long will that last? Because you still have a whole bunch of people that have lost their businesses that have to recoup. And I think after that first boost, you're going to be left with, well, now what? Right? I've gotten my retail therapy. I did it once. Can only go out to so many restaurants and go out for dinners. I'm used to eating at home now, so maybe I won't go out as much. And by the way, there's half as many restaurants.
Yeah. So
there's a need to put the money somewhere. And so other things are going to be going up in price.
That's right. Confidence is not one of confidence definitely is not following that rate higher, but it's very important, like you mentioned, to paint this reality of the economics right now, considering what the economy will look like as things reopen. The Fed is definitely trying to tell us that we should expect faster growth as things reopen, but they're also mentioning inflation at the same time. And that kind of brings us to the Fed. The Fed spoke this week, and in summary, they're going to keep rates stand pat, the status quo until 2024. They see somehow a spike of GDP to 6.5, which is the hole that they're trying to get out at the same time. They're continuing to print QE for another, unlimited amount of QE going forward. 120 billion per month was summarized, and they also see inflation rising above their key level of 2%. Again, so they're indicating that we don't know exactly how high it will go, but expected to be higher than 2%. But there were also others like myself who wanted to hear what would happen when this supplementary liquidity ratio, the SLR, actually comes to an end this month. So when COVID hit, the Fed granted relaxations to the big banks to allow for, you guessed it, more loans and debt. That expires the end of the month. We know that if they implement that, things can get really, really bad. So they'll likely kick the can down the road and cause yields to spike, the 10-year Treasury yield to spike. But again, that's an indication of inflation. But even worse, the bubble will get even more bigger than ever before. So we are looking at precious metals. We've been trading at a level around especially silver, around the 50-day moving average, 26. But it's been throughout this consolidation period with 10-year Treasury yield spiking, it's actually been holding up pretty strongly versus gold. Yeah. So I'm anticipating a major run up in silver because it's showing this relative strength versus gold. But what we're going to see going forward is this U.S. dollar erosion, the U.S. Federal erosion. We've never seen the Federal Reserve note abused like never before. It's never been abused this way ever since the post-World War II era. And I want to point out what the Congressional Budget Office recently warned. So in the U.S., the CBO, the Congressional Budget Office, recently warned that the government's mountain of debt, largely financed at ultra-low interest rates, could become completely unmanageable when rates normalize.
That's right.
They can't raise rates. Every quarter basis point, you owe trillions more to service that interest.
But at some point, you can't stop it either.
You can't.
You can't hold back the rates, suppress rates forever. You can't suppress the price of gold and silver forever when there's such a demand. At some point, the dam breaks. Mm-hmm. There's going to be the flood, and it's going to be biblical.
That's right.
And so you want to make sure that you're protected.
And hear this. The CBO estimates that over the next 30 years after normalization, Uncle Sam will have to come up with $61 trillion in interest. And that's assuming rates only move up modestly. And they bluntly warned us and lawmakers that the current pace of debt expansion will increase the risk of financial crisis. That is a situation which investors lose confidence in the U.S. Federal Reserve note.
You want to get out of that. You do not want to be anywhere near that. You want to have the protection against those problems. You also have the supply demand on this market. The fundamentals are fantastic. Low supply, high demand. The market's going to rip higher. Many technicians out there are seeing that the price of silver could go triple digits. It is a coiled spring. Give us a call, 1-877-8-SILVER. The website, guildhallwealth.com. Thanks for listening to The Real Money Show this week. Can't wait to speak to you next week. And you've been listening on Global News Radio, 640 Toronto.